Intel stock is down a lot. This is a company I've been following, and it gets a lot of criticism, which I understand, but it's a long-term play, as I've said in the videos. The chip business is taking a lot of hits right now. Every chip company is announcing major misses on earnings. PC sales are down, so it is quite the situation. Now, Intel has announced a $20 billion factory right down the road from us in Columbus, Ohio. Just last night, they announced 12,000 employees being laid off. To me, this says that earnings next week are going to be bad. Why else announce 12,000 employees being laid off except for cost cutting? Now, we're going to use our 8-pillar process to look at Intel currently and make some assumptions about the future. Now, I want you to keep in mind, the 8-pillar process is not going to be as effective here. You've got to look at this as a long-term play on Intel. I'm still in on Intel, but it doesn't mean you should be. It has been very frustrating and it has fallen a lot. My basis in Intel is like 45 or 47, something like that. So I'm down almost 50% on my investment. I am absolutely cool with that. If I believe in Intel long-term, that is what I'm doing. If that's not for you, I completely understand. It is hard to watch your stocks fall. But remember, I believe that the stock market in general is massively overpriced and stocks will go lower. That's why only 7% of my money is invested in stocks. So even though I might have a few stocks that are down 40, 45%, it's of positions that are 0.5% or 1% of my portfolio. That's the goal of using the market's position to get into the market and dollar cost average on the way down. That is my goal here. So let's take a look at Intel right away. Let's see what Intel's doing today after announcing it. Okay, they're about even. Last year, $56 a share, and it's at 52-week low is $24.70. All right, let's take a look at the 8 pillars real quick. I think these 8 pillars are a little misleading one thing, revenue growth up $7 billion, net income growth 5.8, but cash flow growth is down 14. Why is that? Guys, they're making major capital expenditure investments into the business. And this is something that they announced last year. They cut the dividend. They did a lot of these things in order to make sure that they position themselves for the future with AMD on their tail. But check out AMD. That's the interesting part. AMD, their 52-week high is 165, and they're currently at 57. Why? Valuation. So even though Intel is down 50%, these guys are down 60 or 70%. Valuation matters. Now, the question is Intel really a value play, or is it just that I'm wrong? Could be one of the two. So let's see what analyst estimates are saying for the company. Earnings per share is currently at $2.31 for the year. They estimate $4 a share in the next by 2026. So let's say hypothetically the stock stays at $25. In 2026, that's a PE of 6. Okay, next, revenue. So even though revenue is dropping this year, they do expect revenue to grow low single digits for the next 4 or 5 years. All right, not big, but still some growth. And that's the key here, guys. Your goal as a value investor should be, can I find a company that's being mispriced by the market? Peter Lynch talks about it. Michael Burry talks about it. In the movie The Big Short, Michael Burry's main investor was saying, hey, we're okay with you buying a stock and it going down 50% and then surging. The question is, has the thesis changed? Mr. Market every single day is going to say, this is what I'm willing to pay you for the stock, or you can buy it for me the same price. That's the question you have to ask. And it's not for the faint of heart, because every good value play is going to be dismissed by the market. That's what makes it that's what makes it a cheap or inexpensive company. That's what you got to remember. Now, let's see here. I want to look at the income statement here. They had a big drop in revenue the last quarter. In the last 10 years, there's been steady growth. Now, guys, they have a couple companies that are growing big time. Their mobile eye division is growing a lot, but it's still a small piece of their business, just like AWS was 10, 12, 15 years ago for Amazon. I'm not saying it's going to become the next AWS, but they have other investments in other areas that are growing. This $20 billion factory in Ohio is going to be the largest factory building chips in the United States. It's going to bring thousands of jobs into the community, which we obviously love a lot. But the whole point about it is they're going to become they're one of the few companies that actually makes their own chips. And that's going to give them a competitive advantage going forward. Now, let's go look at their cash flow statement, because you'll see this big increase in capital expenditures. So capital expenditures over the last 10 years. 11, 8, 7, 10, 15, 16, 24 billion. They had negative free cash over the last 12 months. They're spending a lot of money. Even though, take out this abnormal year of 2020, you look at this, well, actually it's been declining here, but taking out this, it's still declining their operating income. So there is a concern there. The question you have to ask yourself is, 1, do I think Intel will be around in 10 years? 2, if the answer is yes to that, do I think they'll make more revenue or less revenue than they are today? And 3, if that's a yes, if it's more revenue, can I pay a reasonable price for the company today that factors that all in? And that's what you have to ask yourself. So let's go to the stock analyzer tool. As you've watched our videos in the past, stock analyzer tool is what we use in order to make assumptions about the future and tell us what price to pay for the stock today. Okay. It factors in revenue growth, profit margin, free cash flow margin, some sort of multiple in the future on earnings and free cash flow. And then finally, your desired return, which is essentially your margin of safety. So let's start right away on this one. Revenue growth. I'm going to go with -1, 0, and 1%. I'm being so conservative there, right? Just sitting there saying, listen, let's say the company stays the same. Profit margin. Profit margins increased over the last 10 years, but I'm still going to be conservative because I think they're going to have a drop in profit margin. Let's go 20, 22, and 24. Free cash flow margin. Over long periods of time, free cash flow and profit margin should be the same. But as you look right here, there was negative free cash flow, but profit over here because they invested so much in capital expenditures. All right. So I'm going to go with 18, 20, and 22. They're relatively close. Now, PE, look at this PE, 5.4. Now, I'm going to sit there and say 9, 11, and 13. And same with price to free cash flow. Our final metric. Our final thing to input, desired annual return. Guys, you can get 9 or 10% from an ETF. The question you ask yourself is, how much margin of safety do you want in this investment? There's a lot of uncertainty out there. So I can understand if you went higher on the margin of safety here. I'm going to go with 12, 14, and 16. I went much higher on the high side because these are kind of optimistic assumptions, but I personally believe they're somewhat realistic because we're not making some crazy assumption. We're not sitting there saying, oh, they're going to grow 5% a year. No, we're just sitting there saying, listen, the business did $67 billion last year in revenue. Maybe it does $74 billion in 10 years. That's nothing crazy. Okay. Hit the analyze button. Boom. Oh, wow. I'm actually surprised by this. So it's all green. Now, it doesn't mean go out and buy. And keep in mind, this 35 is what we think the stock should be paid for today to get this return. So if we're correct, 16% return for the next 10 years. So this is a discount cash flow model. It says if you own the business 100% and you bought it out for $32 a share and the middle estimates came through with all your cash flow and increase in value, you'd make about 14% on your money. So at this price, you're going to make 15 or 16%. Now, is this a guarantee? Of course not. But if you found 30 or 40 companies that had all these kind of metrics, you'd probably do pretty well. Some would hit really well, probably crush the numbers. Most would probably do about what you think, and some would just absolutely falter. That's the point of value investing. For me, it's about buying. I currently own 13 or 15 companies on my way to 30, 40, or 50, because I like the idea of making a lot of conservative assumptions on a lot of stocks and seeing what happens. But I'm going to focus on free cash flow and the potential in the future. So maybe Intel isn't the right value stock for you because there's so much uncertainty. You need to watch our next video on how to find value stocks so you can start screening on your own to find the value plays that make more sense to you. Thank you very much for your time.